how to trade like the minority and avoid the normal pitfalls of human emotion that causes most people to trade worse than a random trader. Welcome in, fam. Much love. Trav here. Let's get to it. Hope you all are doing amazing. Free trading education. Ideally, it'll be forever free. We'll see if that happens, but it's free for now. So the topic of today is coming from New Market Wizards. If you haven't read the Market Wizards series, it's a must. You can learn about what the profitable traders, the best traders in the world, believe and what they've done. So this chapter is William Eckhart. William Eckhart is Richard Dennis's partner. If you never heard of William Eckhart and Richard Dennis, they're the guys who had a bet of whether you could teach people to trade or if there was an innate trading talent. And they went and taught a bunch of people to trade, called the Turtles. And the Turtles did like 100% a year for a bunch of years. They made hundreds of millions of dollars. So William Eckhart is he's very much a system developer. And I'm going to admit that I almost didn't read this chapter because it started off so boring. He's such a mathematician, it's so technical, but really got into a couple good points here. So one of them, and this is what we're going to look at, is he's saying, and this is crazy, but and I believe this to be true as well, the majority of people trade worse than a purely random trader would. And I know that's true because I've had periods where this is worse than random. Like there's no, like what's happening? And I'm so confused. Have you ever had that? I have, where I've lost like 15 straight trades or only one out of 20 straight trades. And I'm like, if I was trading randomly, I'd be doing so much better. If I reversed my trade, I'd be lights out, right? How is it possible? So we're going to get to that. But the point is that if most people are trading worse than random, you cannot do what most people do. You need to do what a minority of people are doing. So why do people trade worse than random? Well, it's because the market teaches you to trade in a losing way. And the market teaches you, the market behaves in a way that we interpret through our psychological learning, which is intermittent reinforcement. Randomness reinforces our behavior. It teaches us to do dumb things. So here's what he says. He says the market behaves very much like a tutor who's trying to instill poor trading techniques. He says since most small to moderate profits tend to vanish, the market teaches you to cash them in before they get away. Since the market spends more time in consolidations than in trends, it teaches you to buy dips and sell rallies. Since the market trades through the same prices again and again, it seems, if only you wait long enough to return the price that is visited before, it teaches you to hold on to bad trades. The market likes to lull you into a false security of high success rate techniques, which often lose disastrously in the long run. The general idea is that what works most of the time is nearly the opposite of what works in the long run. So first let's reverse what he's saying here. So he's saying you want to let small to moderate profits go away for a chance of getting bigger wins, because the bigger wins are going to move the needle. He's saying that even though the market doesn't trend that often, you want to trade the trends because that's when it's easiest to make the most money. So you want to buy the rally and you want to sell the dip in a trend. He's saying that even though the market seems to often return to the same place, it doesn't always. And if it doesn't and you hold on to a loser, you blow up. So you need to take a stop and take a loss, right? He's saying, let's get the lighting a little bit better. How's this? That looks a little bit better. He's saying that, he's also saying that you need to be okay with a low win rate. That a lot of the people who make a lot of money actually are low win rate traders. Take small losses, get the big win, right? What works most of the time is nearly the opposite of what works in the long run. So the small trades, no, okay. So, so the question is, I'm gonna have to go grab my journal for this. what if we trade like the majority? Let's get more specific, like building our system in a way. What is the minority? What does the majority do? What are the tendencies of the majority? And so how do we want to make our tendencies different? So that's the question we have right now. Okay. So I wrote down some notes here of what. Okay, let's write down. Where did my? Here's the pen. Okay, the majority and minority. So let's start with the majority. This is majority behavior, and we want to not be this. So one of them is to check often. So part of what he's saying is you have to do what goes against human nature. You have to do what's uncomfortable. You have to do what's weird. So we'll start with the majority, and then have the minority of what we should be doing. The majority is to check often, check all the time, be online all the time. Majority human behavior is to take action. Do something, right? Do something. Do something. Another one is to lock in profit. So this is really simple. I've seen these studies they did where it's like, hey, would you rather have $2,000 or flip a coin for $0 or $4,000? Most people say, I'll take the $2,000. What that implies is they're not letting their winner run. And you can take it even more and say, you know what? Flip a coin $2,000 now, or $0 or a chance at $4,200. The expected value of the coin flip is higher. People will still take the 2,000. On the other hand, would you rather lose 2,000 for sure or flip a coin for a $0 loss or a $4,000 loss? People flip a coin. What that implies is people gamble with losses, right? And to take it even further, would you rather take a $2,000 loss or flip a coin for a $0 loss or a $3,000 $800 loss? Or a $4,000 $200 loss? People will still gamble with their loss. They'll risk taking a bigger loss. So that's human nature. Another one is one pet market. This is something most people just trade one market, and usually they've got a couple pet assets too. They only trade stocks, and there's a couple stocks they like. They only trade crypto. They only trade Forex. Everybody's got a pet, right? What else? Another one, majority wants to be consistently profitable. Majority, if I could just be consistently profitable. So what is the minority? What would be the minority? One would be check once a day. Very hard to do, right? Especially if you're a full-time professional trader, to check once a day. Very hard to do. A minority do that. But guess what? A lot of the big winners, this is what they do. They check once a day. They let their system run. They execute their system. And they might work full-time in their trading, but they're doing research. They're studying. They're doing adjacent work that isn't looking at the charts. But checking once a day is hard. The minority do that. Doing nothing is super hard. Logging in. And that could mean taking no trade, being flat. It could also mean not advancing your stops. It could also mean not adding on. It could just doing nothing. Super hard to do. Super hard to do nothing. It's super hard to do nothing when you have unlimited freedom, right? So you want to be a minority. Some days you do nothing. So if the majority is taking quick profit, a minority is no TP, basically. Just let it run as far as it wants to run. Advance your stop. A minority trade like that. And a lot of the guys who make the most money, not all of them, but a lot of them trade like this. Just let it run. Hard to do. It's really hard to do, especially because you're never going to get the perfect most. It's going to retrace, right? This one isn't hard for me, but I guess it's hard for people. But always fixed risk, stop loss. Like always having your stop, right? A minority do that. I think there was I saw a study, I don't know which prop firm, but it was saying like over 50% of traders traded with no stop. Most traders gamble with losses. So the minority, you trade with a fixed stop. Okay, majority trade only one pet market. Most of the best guys, not always, but they trade every market. Not every, but many, like I'll say every asset class, right? They understand the relationship between bonds and gold and the S&P 500 and Bitcoin. And where this gives you an edge is if you're trading only, the combination of trading one pet market with having to take action is disastrous, because when there's no setup and you're compelled to do something, right, you do it. Now the combination of every asset class and taking action takes some of the problem out of that, because if I'm trading every asset, one of them might be setting up really well and I can trade that and ignore the others, right? So take somebody who only trades Euro USD and they rely on that. It's hard to do nothing, right? But this is why there's so much opportunity in other assets. Now, as me, as someone who's trading every asset, if I see a setup in Euro USD, I can take it. But if there's nothing there, I'm just not looking, right? Or I look and I move on. So trading every asset class. Now, the last one is, if a majority wants to be consistent, a minority just wants to be annually profitable, right? I'm just trying to make money this year. I don't care how it happens, right? I'm going to make my money on the market terms, not on my terms. Why am I trying to be consistent at gambling, right? Consistent at the most random thing. We're not looking for consistency. We just want an edge that makes us annually profitable. And what that means is it could have a system, like home run systems do really well. A system where you have a lot of losses, you have a low win percentage. Every once in a while, you have a huge win, right? And again, what I've seen, so many of the best guys have like a 30% win percentage. But their wins are so much bigger than their losses, 3R, 4R, 5R, 10R, that they're able to make a lot of money. So the majority of traders trade worse than random. They're checking all the time, they're taking action all the time, they're quick to lock in profit, but they're gambling with their losses. They're trading one pet market, and they're trying to be very consistent in everything they do. The minority checks the market one time a day. Oftentimes they do nothing. They don't have a TP. They don't take P. They don't take profit. They let it run. They have a fixed stop. And wherever the stop is, that's where the stop trade ends. They trade every asset class, and they're not so worried about every month. They're just trying to make money when the year ends, right? So this goes against human nature, right? It's human nature to check often. Well, this is why I have my phone locker. It's human nature to take action. Well, this is why you stay busy, have other things to do. It's human nature to want to take profit. Well, you have to learn to let it run. It's human nature to not want to take a loss. Well, for me, for whatever reason, it's easy to take a loss. That one's always been easy. Yeah, it's human nature to just want to trade one thing, but I've just kind of learned this is the way it needs to go. So let's see if there's any other ones that I wrote down here. Those are the main ones, but please leave in the comments if there's anything the majority of people do in trading. What else is it? Comment down below. Hope you found it useful. Appreciate you. Much love, and look forward to talking to you soon. Peace.